Oh, the bond yields are up 4 basis points this morning on basically no news, but we'll cover all of that in a little few minutes. I think the bond yields are killing the Santa Claus Rally and turning Tesla slightly into the red in the early goings. I don't think it'll take much to reverse this trend, but maybe we also just needed a day off. Not to be a party pooper, since I've already started out the morning with being a party pooper, but I do continue to think that Tesla is fully valued in this range until there's news to give us a reason to penetrate 500. We could go above, but I said about a month ago that I think that this is about where we're going to be for now. We're already way above where I expected us to be. And yeah, I think we've run out of steam until we get more news. There's continued talks about the elimination of the $7,500 IRA credit. Let me say again, this was a very complex bill to pass. It is going to be a very complex bill to unwind. I think the earliest possible date would be July 1, but more like January 1 of 2026. There are way bigger priorities for the DOGE Commission, and for Congress going into this new administration than to unwind that $7,500 credit. So, yeah, I think, again, probably the bill will be considered, maybe starting to be considered by the end of the first quarter. Will take until the end of the second quarter to pass something new, and they'll put it in as a January 1 of next year. Now, remember, when this happens, it's going to have a pull forward effect for a quarter or two as people try to beat the change. And then ultimately, depending on whether we have the FSD unsupervised or not, it might impact some sales of Tesla vehicles for a while. But if FSD unsupervised happens, I don't see that there's any chance that there will be any demand problems for Tesla vehicles. But I could be wrong, but that's what I think. Wow. Every once in a while you find an article in the old press, the kind of the normal press, and they actually understand Tesla or actually understand Elon. So I didn't notice, I didn't know who this was. I thought I did. I was almost sure I put down who this was. But anyway, here's the story. In a world where businesses obsess over competitive landscapes, Tesla and SpaceX CEO Elon Musk shared a contrarian stance that might actually go against the grain in the world of marketing and growing a business. Quote, I'm not sure looking at competitors really helps. It's sort of like the old adage of running. If you start looking at the other runners, it's not good. This is something that Musk remarked, shedding light on his relentless focus on innovation over rivalry. By the way, this is exactly how I've run my businesses my entire life. You got to know what the competition is doing. You got to be interested in what they're doing, but you don't spend any time on it. Musk's analogy emphasizes the dangers of getting distracted by what others are doing. In his view, constant comparison can sap energy and dilute a company's unique vision. Instead, he advises founders and teams to double down on creating transformative products and experiences. And by the way, that's why I don't cover the competitors on this channel. You might have noticed that. I talk about it from time to time, but usually it's in terms of the broader future of the overall market, the overall EV, or something general with regard to the economy. Tesla's early days, quote, rather than chase established car makers, Tesla forged its own path in electric mobility. The company funneled its efforts into battery tech and consumer-friendly design, eventually setting a new standard for electric vehicles, spurring its competitors to catch up. SpaceX reusable rocket strategy, while aerospace giants followed traditional and costly use it once and throw it away methods, Musk and his engineers assigned to figure out how to land rockets safely back on Earth. Their unwavering focus on the breakthrough rather than a competitor benchmarks led to industry-wide revolution in spaceflight economics, and nobody's even close to following them at this point. The roots of Musk's philosophies, Elon Musk's perspective on ignoring competitors. By the way, this is important. That's why I'm going into the full detail here. Zip2 and PayPal. These were his first two companies. That Zip2 Musk sought to place local businesses online at a time when few understood the internet's potential. With PayPal, then known as X.com, Musk didn't worry much about the traditional banks were doing. He focused on building a seamless online payment system. Risk and reward. Through his career, Musk has repeatedly taken risks that many consider unwise, pouring millions of dollars into ventures without being swayed by existing marketing leaders. For Musk, true innovation means forging your own road rather than following a well-worn path. Vision over victory. Musk concentrates on long-term goals, cultivating talent. He hires individuals who can solve complex engineering problems and who aren't afraid to disregard conventional wisdom. Narrative experimentation at both Tesla and SpaceX. Rapid prototyping takes precedence over extensive competitor analysis. What's the lesson for aspiring founders and for people that are watching this space? By likening marketing competition to a race, Musk highlights a timeless principle. Focusing on your own lane often breeds better performance. For entrepreneurs, this means channeling time and energy towards product development, team building, and customer needs rather than perpetual anxieties about how the rivals are faring. As Musk's companies continue to reshape entire industries, his advice rings clear. True innovation is rarely found by staring at your rivals. By keeping eyes on the finish line and directing your passion inward, you just might create the future's next billion-dollar breakthrough. This is so critical in understanding who Elon Musk is. This is from jasondeegan.com. Starlink is developing a new service called Starlink Direct to Cell, which aims to provide 4G connectivity via satellites. This innovation can make it possible for anyone, anywhere with a standard smartphone to access the network with no additional hardware required. While Starlink Direct-to-Call is still in development, Musk has already committed to making one feature universally accessible: free emergency calls. This means that even the most remote or disconnected areas where traditional mobile networks completely fail, people in distress will be able to reach emergency services without needing any subscription. Quote, after much thought, SpaceX Starlink will provide free access to emergency services for mobile phones, unquote, Musk announced on X. This applies worldwide pending government approval. No one should ever die because they couldn't pay or they forgot their own phone. This decision underscores Musk's commitment to leveraging technology for the greater good, even when it doesn't immediately benefit the company's bottom line. Huge conversation this morning on, this is a news story, by the way. I don't want to forget to indent on my next paragraph. Huge conversation on X about importing top engineering and other talent from around the world. Quote, maybe not surprising, number of folks are against immigration, even if the immigrants are going to be a clear positive. That wasn't a quote, that was me. Maybe it's not so surprising. I don't understand why people are against immigration when it's going to have a clear advantage to the country to have those immigrants come in. Anyway, Elon Musk is now quoted as saying on X this morning, it comes down to this: do you want America to win or do you want America to lose? If you force the world's best talent to play on the other side, America will lose. End of story. I might dig deeper into this business of various kinds of visas with regard to different kinds of groups. One thing I know for certain, we need to bring in more medical people. The shortage is massive and growing. Optimists could come to the rescue, but let's not count on that. What we need is more engineers, more medical people, and there's other categories that are sadly undersupplied as well. This is Randy Kirk. Please hit like. No, actually hit like. Yeah, thank you. Appreciate that. Okay. Hit subscribe, hit notify. We got Bradford, Ferguson on Thursday as usual, and then that'll be followed by Cern Basher at 7:45. And, Patreon. Okay. In the week ending December 21st, the advanced figure for seasonally adjusted initial claims was 219,000, a decrease of 1,000 from the previous week's unrevised level of 220,000. The 4-week moving average was 225,000, which was a slight increase of 1,000 from the previous revised week. So this was a beat compared to what the street was expecting. Well, if you look at the beat, meaning fewer people unemployed. The advanced seasonally adjusted insured unemployment rate was 1.3% for the week ending December 14th, an increase of 0.1% over the previous week's unrevised rate. The advanced number for seasonally adjusted insured unemployment during the week ending December 14th was 1.9 million, an increase of 46,000. This is the important one. So this is what real 𝐄𝐦𝐚𝐢𝐥 𝐄𝐦𝐚𝐢𝐥, he adds some color to this. He says, initial UI claims are essentially flat, but continued claims are now above 1.9 million for the first time since November of 2021. Increasingly seems that unemployment is growing not so much because of mass layoffs, but that those losing their jobs cannot find new work. Now, that's sometimes because they don't want to. They take it as a vacation. They're okay with the income, especially, second incomes. Anyway, I saw this all the time. I used it as a way to decide who to lay off. The people that had second incomes, they were like, yeah, I'll stay home with my baby. The 4-week moving average was 1.881 million, and increase of 3,250 from the previous week's revised average. The total number of continued weeks claimed for benefits in all programs was 1.892 million, a decrease of 67,000, which was actually good. All right, this is an article that I really think you should pay attention to. You know how I feel about productivity. This is extremely well written. This is extremely well thought through. This is extremely useful. So I'm suggesting you really listen up. You don't have to. The U.S. could be on the cusp of a productivity boom, similar to the one triggered by internal technology in the 1990s. The outlook for the national debt and much else depends on it. Worker productivity is regarded by economists as one of the most important drivers of long-term economic performance. Absolutely. It is essentially just the total output of the economy divided by the number of hours worked, aided by investments in technology and capital. When productivity is booming, it allows the economy to expand faster without triggering inflation, might even result in deflation. That has positive knock-on effects on all kinds of things, including the fiscal health of the federal government. This is what I've been talking about. Quarterly fluctuations in productivity can be notoriously volatile. The pandemic rendered the data almost impossible to interpret, as both total output and hours worked swung violently. Recently, however, there's been a clear and highly encouraging upward trend. Preliminary estimate, but it's been less than I expected. You may remember I thought we would have a tremendous change as companies got rid of those employees that they were holding on to for fear of, not being able to hire new folks. But no, it was really slow, and they hung on to that labor group. But preliminary estimates from the Bureau of Labor Statistics show that total non-farm business sector labor productivity increased 2% from the year earlier in the third quarter. This is the fifth straight quarter growth above 2%. That is significant, as the average rate for the 5 years before the pandemic was only 1.6. Jeff Schulz, head of economic and marketing strategy at ClearBridge Investments, argues this productivity jump is thanks to some unique features of the post-pandemic labor market. People have switched jobs, locations, and even industries at a very high rate, meaning that workers are now better matched to their roles, he said in an interview. In addition, the extreme labor market tightness of the post-pandemic period led companies to step up investment in time and labor-saving technology. And what they don't add here is that those people have now been on the job for a while, so they've learned their job. This is huge in terms of productivity. Quote, I believe that workers are just much better matched to their jobs. And what's happening now is they are better matched, and they've been in their roles, for a couple of years. You see, you're seeing a boost in productivity that's going to continue over the next couple of years. And that's even before all of the investment in artificial intelligence even comes to fruition, according to Schulz. When you look at this horizon with all this investment in AI, it's not hard to get too excited about a productivity boom that will move us up to the 2.5 or even 3% levels. I think even higher. Cathie Wood thinks much higher. To see what a big difference faster productivity could make if it was sustained, consider the congressional budget's office's long-term debt projection. These are based on estimates of total factor productivity, a somewhat more abstract feature that takes into account the productivity of both labor and capital. But the fundamental drivers and direction are similar to labor force productivity. Under its base case scenario in May 2024, the CBO sees federal debt held by the public rising from 99% of gross domestic product in 2024 to 116% in 2034. This assumes total factor productivity growth of just 1.1% per year. Raising this estimated productivity growth by half a percentage point would mean the debt to GDP ratio a much more manageable 108%. Optimists would argue that the U.S. could do much better. Strategist Ed Yardeni, you know who he is, of Yardeni Research, advocate for a roaring 20 scenario where he sees rapid growth this decade, driven in part by AI productivity boom. Due to the volatility of productivity data, he prefers to look at the rolling 5-year average of labor productivity growth, which hit an annualized pace of 1.9 in the third quarter of 2024 from a low of just 0.6 in the fourth quarter of 2015. Yardeni believes this could reach 3.5 in the second half of this decade. That might sound delusional, but past productivity booms in the 50s and the 60s and the 90s all peaked at 3.5 to 4%, he said. These past booms each had their own drivers, according to Yardeni. The interstate highway build-out, the rapid suburbanization, mainframe computers, jet engines, and of course, personal computers and the internet in the 90s. As these examples make clear, investment by both the public and private sectors can drive productivity gain. Under the Biden administration, the optimistic case for productivity was built partly on fiscal spending by the federal government, which was designed to encourage a crowd in private investment as priorities for instance, domestic chip production, clean energy, and electric vehicles. I agree with the domestic chip production. That was his number one thing that he did. He is less optimistic that lower corporate taxes under the second Trump administration would have a positive impact on investment. Why not? Why wouldn't it? That's just ridiculous. Anyway, others see that the tax policy can keep encouraging investment in productivity-enhancing technology. Clearbridge's Schulz points to the full expensing of investments in equipment, a provision of the 2017 tax cuts that began being phased out in 2023 but can be renewed in the new tax package. For his part, Yardeni said he began talking about a roaring 20 scenario in 2019, and it was never based on assumptions about these policies. Anyway, I'm going to skip here. This is, who is this? This is Aaron Back. I believe that workers are just much better matched to their jobs today. Whoops, something got copied. For those hoping the U.S. economy can keep up its growth and resilience no matter what happens in the nation's capital, productivity growth holds the key. Quarterly productivity readings, volatile as they may be, will be one of the most important indicators to watch in the years ahead. Well, let's see if productivity is helping those bonds get a little bit more activity this morning in the right direction before we get there. All right, so everything is moving back towards the positive. I told you that it might not stay this way. So we've got Tesla almost back in the green, only down 36 cents. We've got the Dow Jones almost back in the green, only down 72. NASDAQ down 38. S&P only down 11 at this point. We have got the Magnificent Seven, which was almost all in the red. Well, still mostly in the red. Only Apple, Google, and now Tesla up 17 cents. Those three are up. The other four are still down, but moving in the right direction. All four moving in the right direction. You've got the Cathie Wood stocks, which were 100% in the red earlier, now all 100% in the green by, 8 cents, 11 cents. So not really that strong, but all headed that way. So the Santa Claus Rally had it tripped. I don't know. Does Santa Claus trip? Anyway, it is now doing much better. We'll see if that continues on. Tesla continuing to move up. Let's take a look at these percentages. Okay, the Dow down 17%. I'm sorry, 0.17%. NASDAQ also 0.17. S&P down 0.18. Wow. And Tesla down 1.17. That's weird. That never happens. That is very weird. Anyway, it'll all change in a minute. We'll come back and look at Tesla before we leave. Okay, let's go ahead and look at where those bonds, have the bonds impacted things yet in a better direction? No. This is happening despite the bonds. So the 10-year is still up 4.8%, 4.8 basis points this morning at 4.635. This is just, it's stunning, stunning. That's all I can say. 2-year is up 3.3 basis points, 4.363, and the 1 month is up 2 basis points at 4.314. Yeah, it's unbelievable. Okay, I don't know what to say. I know that's unusual for me. I always know what to say, right? Okay, oil up this morning, 9 cents. Wow. $70.19 for Texas, 73.65 for Brent, and natural gas actually down 6% this morning, but still in a high level, $3.71. Gold firming up a bit this morning, but right in the middle of its range, up $16 at 2,651. Silver also up a little bit, 0.5% this morning at $30.43, where it has been pretty close to, that's where it's been for a while. Copper up 0.66 this morning, 4.137, also in the middle of its range. Okay, we got Bitcoin down 3,208 or 3.24% at 95,829. So Bitcoin selling off this morning with that bond action. I think there's a relationship. Maybe not, but because Bitcoin, I mean, it's in a world of its own. To a great degree. All right, so let's go back as we always do. Remind you again, how much better can it be than Cern Basher and Bradford Ferguson in the same day? Bradford will be on around 5 o'clock and Cern Basher at exactly 7:45. So you want to come back for both of those, and hitting that like button and all that stuff would be great, but even better would be joining Patreon and participating in my success. Let's see. All right, let's go back. Take one last look at Tesla. Back down to being up exactly $0.00 is where it's up right now. You remember what we used to say in sports, tie, favor, runner. So we're exactly zero, which is positive, I think. Anyway, that's all I got for you right now. As always, it has been great talking to you.